Peter, this has been insulated for quite a while. Why do you think that's going to change?
Well, again, I think it surrounds the very clear change in attitude that the administration now has vis-a-vis China. And to me, honestly, it seems a bit esoteric, but I think an important tipping point in the attitude towards China was a real strategic shift in the administration's position around claims to sovereignty in islands in the South China Sea. And Secretary of State Pompeo came out and said that we do not sanction or support those claims, which frankly has been, to me, an important complicating issue relative to the trade war itself, because so much trade passes through that region, and it's been an area that's been starkly absent from the discussions when, in my view, it should have been part and parcel of those discussions from the very get-go.
Peter, big tech has got wrapped up in this in the last couple of days, particularly the last week or so. There's some people looking at this market right now, and it's on the screen at the moment. Equity futures up 0.4 on the S&P, the underperformance coming from the Nasdaq again. What's your interpretation of what's happening in the equity market right now? Is this just one of those rotations that lasts a couple of weeks, or is there something more to the price action on the screen of the last couple of days?
Yeah, well, my view is that this is all about the perception of policy support, and any hiccups relative to fiscal policy support in particular could derail the rally quite easily. And I look at, the analysis of markets over the long term as being really one of risk-reward asymmetries, right? So very few of us are good at picking tops and bottoms in markets. But in situations like this, where you have the S&P, notwithstanding the fact, again, that big tech has been driving this and it's totally disconnected from the real economy, when you have an S&P forward multiple of about 26 times, it's very difficult to convince yourself that there's good risk reward to equities. And frankly, you're a credit guy, John. When you look at high yield, with 40% of the high yield deals that were done this week below 4%, a similar argument can be made for high yield, and that's clearly part of the reason why equities are rallying the way they are as well.
Peter, it seems to me that the Treasury market's very much in the driving seat right now. Yields are higher by 6 basis points on 30s, up 5-6 basis points on 10s. As soon as you get that move, you get a rotation in the equity market away from growth. What do you see in the commodity market? Gold starts to pull back. Why? Because real yields have been so supportive of what has happened in precious metals too. You're sticking with the gold trade, Peter. Why?
Yes, I am. And I was, I think, pretty clear in one of my recent notes that you could, after this massive run-up in both gold and silver, you can certainly see pullbacks and corrections. Nothing ever seems to go straight up or straight down. But I'm sticking with it because I think it remains the primary Treasury substitute globally, especially for foreign market participants that wish to diversify away from U.S. Treasuries as a store of dollar value. And in fact, that last piece is important, John, because that store of dollar value part does not necessarily mean that I like gold because I think the dollar will get weaker. In fact, I also am maintaining my view that the dollar is probably near something of a floor because structurally the world is short dollars and in need of them.
Peter, does it offer me that inverse correlation, though? Or does it offer me inverse correlation to a specific part of this equity market, i.e. the cyclical areas of the stock market? Because right now, big tech's down, gold's down too. We've seen plenty of days when big tech is up and gold is up as well. Can you walk me through the inverse correlation and where you're getting that inverse correlation from gold?
Yeah, I think, again, gold can serve many purposes at different times. And I wouldn't consider it either an inflation hedge here, right? Because it's actually, we've been in something of a disinflationary environment and gold has been rallying quite well. And I wouldn't necessarily consider it a risk hedge either. I really think this is about a much broader dynamic about the desire to diversify away from treasuries, frankly, from non-equity market participants like foreign central banks. I would say, though, circling back to this seeming rotation into cyclicals, I was taken by surprise by the rotation out of tech and into small caps, and the Russell 2000 in particular over the past few days. I don't think that's a sustainable rally. And I think that particularly so because when you look at the regional bank or the small bank subcomponent of the Russell 2000, it has really not performed well. And it's still, I think, about 30% off for the year. And without the participation of smaller banks, which are the real economy, by the way, they represent the real economy quite well, I don't think we can get a sustainable rally in small cap stocks more broadly.